I want to bring in our next guest. We have Joseph Minarik, former chief economist of the Office of Management and Budget under President Clinton. And Joe, it's great to have you on the program this afternoon. Let's start with some of the recent economic data that we've gotten out and help us make sense of what we've seen. Because big picture, I think there's been a slight improvement, although overall there's still many signs of weakness. For example, that jobless claims number that we got yesterday, that small week over week decline, alerted some economists out there. What is your reading just on where the economy stands at this point?
We're in a transition phase as the fiscal stimulus, including the Paycheck Protection Program and those rebate checks, is wearing off. We have a deadline in the end of July for the increase in unemployment benefits, which is that's going to be more like a cliff out there. The other programs are just wearing off gradually. And what that means is that, it's like the tidal wave that is kind of slowly making its way back out across the shoreline. We're starting to see some of the damage that has been done. And that damage includes a lot of hits on small businesses, retail establishments. People are going back to work at retail stores, but a lot of people don't want to go and shop. Those retail establishments that require social distancing are not able to operate at the scale at which they're normally profitable. And on top of that, they have all the other expenses for safeguards and sanitation. So the question is, as the fiscal stimulus wears off, as these businesses begin operating, but well below their previous scale and possibly not profitably, are we going to see anything more of the short-term bounce back that we've gotten over the last 6-8 weeks or so?
Hey, Joe, Rick Newman here. This is a very amorphous recession so far. We can't tell how bad it is, how long it's going to last, whether people are going to go back to work quickly or be out of work for a long time. Do you feel like this is kind of turning into a contained recession where, there are a certain, if you're in one of those industries, retail, travel, for example, you're in tough shape for a period of time, but everything else is kind of coming back? Or do you think it's going to be an economy-wide recession?
Certainly, we have had particular sectors of the economy hit extraordinarily hard at the beginning. But of course, that pain spreads out. And now we have all the questions left about whether, in fact, we're seeing a new first wave in Texas, California, North Carolina, et cetera. Florida, is that going to give the economy a second hit overall? That maintains a risk. I suspect that even though the impact is uneven, it generalizes over time, and that's really the danger as I see it.
Joe, there's still a lot of debate about, how much additional stimulus is needed, at least as it relates to individuals. And I'm wondering what you make of this idea that's been floated around from those like Tim Geithner and Jason Furman, who say that it should be more of a targeted approach. So in this next phase, if a state, for example, has unemployment above 15%, well, then you would continue a certain amount of stimulus and then reduce it once it drops below 7%. Is that an approach that you think would work in this phase?
Well, we definitely want to scale the degree of stimulus, and as the economy recovers, you want to withdraw it. But it can't be targeted as heavily as you might like on affected sectors. We do have an across-the-board problem with relatively small businesses. Small businesses operate typically on very low cash reserves, so many have been hit already. Many of those that were required to shut down because of public health concerns are not going to be able to come back. So the Paycheck Protection Program loans, as a concept, seem to be well targeted, but they got crosswise with the changes in unemployment compensation in an unfortunate way. We're learning things as we go along, but we will need more fiscal stimulus for the economy. And as we begin to get businesses reopening, we're probably going to see that assistance becoming somewhat more generalized, so that we just have people walking into those stores rather than necessarily having assistance to the businesses themselves.
Joe, since you used to work at OMB, a budget question. We've got this explosion in the national debt, now around $26 trillion because of all the deficit spending. Can we just tolerate that for the foreseeable future, or do we need to start paying that down once we get to the other side of this recession?
My personal position would be that we need to demonstrate to the financial markets that we are going to contain the problem and take this incremental debt. What I would do, and I wrote a column recently, what I would do is segregate the new and incremental debt that is coming from the crisis itself. I would dedicate a revenue source to servicing that debt. I'd finance it long term, and I would use the proceeds of that revenue source guaranteed to service that debt and over a period of time to pay it down. As you know, when the crisis was just beginning, before the crisis began, we already had a debt problem. And we need to indicate to the financial markets that this is not going to get any worse. And then when the economy, in fact, does recover, we need to have a program to deal with the pre-existing debt problem, which was already very serious.
All right, Joe Minarik, former OMB Chief Economist. Great to see you. Thanks so much for taking the time once again to come on the show.
Happy to be here.